Everybody, this is Chris McHeffey of BXCIO here with Tim Fortier, the Chief Investment Strategist of Drawbridge Strategies and BXCIO. Wanted to get on today to share some interesting developments in the market. Tim, in the process of managing portfolios and managing risk for clients, uses a lot of different indicators to try and listen to what the market is trying to tell us. And he shared something this morning that I found a little bit surprising, but it's got some pretty interesting implications for what we might want to be doing to adjust our portfolios right now. So with that, let me bring on Tim to take us through what he sees.
Well, thank you, Chris. At the beginning of August, I was telling clients, and I think I even posted this on LinkedIn, that I thought that probably the most important chart to be focused on for August was interest rates. And specifically, I was watching the 10-year for a breakout above the 420, 424 level. And the chart I have here on my screen is indeed the 10-year constant maturity. And we did get briefly a break above that level. And, as interest rates were rising all of that month, that brought equity prices lower. And particularly, it brought lower the growth stocks, which are very sensitive to interest rates because they're priced, as you know, on a multiple of cash flow. And the higher interest rates go, the harder it is to price those stocks at higher multiples. So what we saw then in the month of August was a decline. And there's this channel in the NAS that goes back toward the lows of the year. And we actually came down and actually hit right off the channel, this target was actually drawn at the beginning of the month. And it was this really simple observation of like, okay, we've got volume profile kind of indicating an important zone, and we had this channel. So that was kind of, what got us through the month, which was a little on the negative side. Looking at most of the asset classes this morning, and I think every major asset class, with the exception of high yield, was up just a little less than 1%. But most of the equity indices were indeed in negative territory for the month of August. Then comes the labor report, and the labor report was weaker than expected. And so, we had just had Powell a week ago at Jackson Hole being very hawkish, talking about need perhaps for further increase in rates. And then we get this job report, which was weaker, and that's a key number that he looks at. And so bond market basically gave a sigh of relief. And we've seen now that since that number came out, that rates have started to back off. And so we've gone from about a 438, 436 level here down to about 409 where we are presently. So as that's been occurring, the stocks have started to act a little more constructively. You can see how we've kind of bounced off this channel right here. But more importantly, what I look at more than price is my favorite kind of indicators are what I would call market internal indicators. And what I mean by that is I want to look at beneath price to participation. And so one of my favorite tools for that is something that it's something I developed around a traditional indicator called the bullish percent. And normally bullish percents are depicted on point and figure charts. This is using the same data, but it's in a clearly different format. And what this is showing us, so this is, this line right here is back around the beginning of August. And what we're measuring is the percentage of stocks within the market that are, both for simple definition, we'll say bullish or bearish. And so when the number of stocks that are bullish is diminishing, as it was happening here in late July and early August, I've got this set up so that it generates, there's three conditions that have to happen, but the lines, for brevity of this video, this line denotes where we got the sell signal. And you can see for the month of August that we indeed had this indicator clearly, descending, and which was telling us really what was happening as well. If we go back and look at what was going on in the equity market, you can see how these NASDAQ futures were trading with this very well-defined trend channel, kind of a channel within a bigger channel. So what happened, though, in just the last few days is that we are now seeing indication that demand is significant enough to where we now have just the opposite signal. So here we are closing out the month of August, entering September, and we have a new buy signal, and which is really encouraging. We can further look at things like the SOX index or the semis. The semis, as you know, Chris, are often called the barometer to the technology stocks. And this is a point and figure chart of the semis, and you can see that they have reversed up in a column of X's. And that tells us that demand has come back into that sector. So that's encouraging. Over here, we'll look at. I want to look at one other indicator. Here we go. So another type of an internal indicator. So beyond the bullish percents, I like to look at the health of the market through the lens of percentage of stocks above a key moving average. And so a lot of institutions like to look at the 50-day moving average. It's usually considered a sign of health if the market or if a stock is above the 50-day. So by looking at what percent are above the 50-day, whether it's rising or falling in the relative level, we can get a sense of how healthy the market is. And so generally when the market is below 50%, when there's 50% or less of the stocks below the 50-day moving average, that's usually a sign of a weak market. But there's also importance in terms of the extremes. And so market peaks tend to occur. You can see here, and again here. Market peaks tend to occur when you get to 70, 80%. Usually there's a lot of enthusiasm for stocks at that point, but the discipline of this indicator is that you are forced to start acting opposite of what the crowd is doing. And so here, the crowd is probably getting very excited about owning stocks, but the proper methodology here is or protocol is to start thinking about getting defensive and increasing your sell stops and so on. So indeed, for the month of August, you can see we had a very sharp decline in this. But the other end of the field is also equally interesting because occasionally and rarely you get these extreme moves down well below 30%. And usually in a market crash scenario, you go single digit, but that's rare. You more likely get moves that are just at 230% or a little below. And you can see right here that earlier in the year, we came down and V'd off the 30, which actually carried this last leg all the way back up. We came back down and guess again, same level, 30%, and we bounced back up here. So that says that more stocks are becoming active. They're getting above their 50-day moving average. And should this now get back above 50, then that would say that more than 50% of the stocks are above their 50-day, and would be a sign that the market is getting healthier. Now, one last thing that I look at on this chart, this is the relative strength of the equal weight S&P to the SPY, and you can see that it's been generally, as we know, we've got the Magnificent Seven. It's been a very FANG-oriented type of market this year with all the excitement on AI, which has driven the technology sector. So in that kind of scenario, the equal weight S&P has vastly underperformed the cap-weighted S&P. And that right now does not look like it's changing anytime soon. It looks like the equal weight S&P could be reaching for a new low right here. But that also does fit into what else I was showing, which is that we've got the NASDAQ bullish percent and the semis showing strength. So it looks to be at least an echo of what we have seen earlier in the year. And I would suggest that perhaps it's because that we're getting a breather in the interest rates.
It's great. So it sounds like you've got a sentiment indicator that's giving you a positive signal. You've got price indicators that are giving you positive signals. You've got moving average indicators that are giving you positive signals, all with the backdrop of the interest rate environment potentially being less threatening than we thought it would be previously. It doesn't feel like things are giddy out there, yet you've got all these, these positive signals from the market. How does that manifest itself in the way you might make portfolio adjustments with this information?
Well, we have two levels. So we run a lot of models that are purely algorithmic, and they're using absolute and cross-sectional kind of momentum and volatility studies to make determinations. So for the most part, we don't interfere with what those signals are. Models though don't exist in a vacuum, and so if we want to make further adjustments to risk on, risk off, this would give us information in terms of any tilts that we might want to make. Like last month, for example, we have it's a very aggressive model that selects stocks from the S&P 100, and in that particular environment, when we had the bullish percents turning down and these other indicators turning down, I did chose to basically hold that model in cash, which was the right call. It saved about 4% of loss. But when you see something like this happen, it gives you the conviction behind that, to go back to risk on for, the current cycle, which, a lot of our models will be rebalancing and trading in the morning. And so this is actually the perfect time to get a risk on kind of signal, because we'll have a whole month here of trading in front of us.
That's great. Well, we didn't want to take up a tremendous amount of everybody's time, but we did want to get on and kind of share these thoughts because we thought they were relevant to, to a lot of people that have that are involved in the markets. So with that, we'll wrap for the day. Thanks a lot, Tim.
Thank you.